What is up, Steve here? I hope you are doing well. I've gotten this question many times and I kind of wanted to address it in this video and talk about how a recession could negatively affect the housing market. I want to talk about different ways of how it could. I think it absolutely can, and I think in this coming market it absolutely will. And I think that this recession is going to be worse than it's going to be bad in my professional opinion based on a lot of different macroeconomic factors. But let's just dive into this in terms of how the recession will affect housing. So for one thing, I think that we're going to have less buyers. Traditionally, people are going to be more tight. They're going to be more tight on their financing capabilities. They're going to be more cautious and everything else. So there's going to be traditionally less buyers. That's going to lead to houses taking longer to sell. And then if houses are taking longer to sell and they're sitting on the market, more inventory is going to come to market. And then the simple supply and demand. So supply is going to increase, demand is going to decrease, and then we're going to start seeing prices come down even further. I think that we're going to see more and more price drops over the next literally 6 to 18 months. I think prices are going to fall in a lot of areas. Not all areas. I know some people are always like, you know, my area is not crashing. I get it. Not all areas. But a lot of places are overvalued, including this area in Southwest Florida. And I think we're going to see prices go down, especially with everything, all the turmoil that's going on right now in our economy. The next thing is buyers have less money. So they, especially right now with inflation, people are being squeezed, and the price of fuel as well. I mean, there's no indication from the administration on what they're doing to curb the high prices of fuel or inflation. Inflation, they got Powell and Yellen over there, two bobbleheads trying to figure out what the hell they're going to do because they really have no options but to raise rates. And when they raise rates, it's just going to raise the cost of debt for everything. And eventually it's going to push us into a recession, I believe. But people have less money, so they are budgeting more carefully because they are trying to figure out, you know, how can I properly budget to pay bills and pay a mortgage? So we're going to see less money in the system coming out of buyers' pockets. The next thing, in a recession, you have a lot of job uncertainty. We're seeing it right now. And what a lot of people don't understand, and I encourage you guys to even Google or DuckDuckGo the word zombie corporations. There's a lot of corporations out there that are insolvent, meaning without cheap debt, they cannot pay all of their bills. Now that cheap debt, based on the Fed raising rates, is going to get more expensive, and then they're eventually going to surface, show their hands that, hey, we can't afford our bills. We're going to default on debt. That's going to cause major layoffs. It's going to cause major layoffs with companies that you might not even think that are in trouble. And unfortunately, I think that there's going to be a lot of job uncertainty, even with people not thinking that they might think that their company is in good shape, but maybe they're downsizing and they're kind of scared. And we're seeing a lot of downsizing right now in a lot of real estate related companies like mortgages, but also a lot of tech companies. And I think we're going to just continually see more and more job losses as time progresses. And also, in terms of job uncertainty, household wages are not keeping up with inflation. So, you know, if your average annual increase is 3 or even 5%, with the cost of real inflation, I mean, a lot of economists like Peter Schiff are saying 15 to 20% is the real inflation. But right now, and I did a video on this in terms of the CPI coming out last week at 8.6%. Even if you took that number at 8.6, wage increases are just not keeping up. So people have less money, and again, the job uncertainty. Banks are starting to tighten up in a recession. They're starting to tighten up even more right now. And lending will become more and more difficult because there's going to be more and more risky borrowers out there that already have loans that are starting to default. And banks need to get good quality borrowers. So they're going to go after borrowers. They need to lend money to stay in business, but they need borrowers that have really good credit. They have assets. they have low debt position and high income. And a lot of other people are just not, they're simply not going to be able to afford or get financing for a house, which is going to in turn bring less buyers to the housing market. All of this combined contributes also to less disposable income. So what happens when you have less disposable income? You have a lot of people who are in the market for second homes, vacation homes. That's going to go away. And that is a big, especially in an area like Southwest Florida here, that's a big part of housing transactions are people who own second homes. Also, if these people have job losses or there's a lot of uncertainty, or especially with the stock market and everything going down, people are more inclined to sell off those properties. So that would in turn increase the amount of supply to the housing market as well. Which brings me into my next thing is the stock market, retirement accounts, your IRAs, your everything pertaining to your your stock portfolios. People are getting a huge hit right now. People are fearful, and the last thing that they're going to do is over leverage for a house, or at least I'm hoping people are not over leveraging for a house and or getting into adjustable rate mortgages and everything else. I've done other videos on that too. They just got to be super careful with that kind of stuff. But people's retirements are just getting eroded away. They're freaking out. So the last thing that they're going to be doing is buying a second home, or they thought everything was great when it was, and how quickly it turned. And they might have been in the market for $1 million house, and now they're like, I'm not going to take that kind of risk. Because my stock portfolio just went down by 30%, my crypto account just went down by 60%, or whatever it is. Now, I have another video that's coming out, or that already launched, and I'll put it in the link or the description below for you guys. And it's talking about the massive opportunities that are to come and how you guys need to prepare if you guys are interested in buying real estate, investing in real estate, or even if it's your first home, or even if you want to do some house hacking. Take a look at that video, because it's going to be important that you guys are preparing right now, because the market, the real estate market, the housing market, I believe in my professional experience, is going to be completely different 12, 18, 24 months from now. As always, I appreciate you guys being here with me, and I'll see you guys on that next video. Thanks a lot.